it is the hello welcome back Trump rally, which in a sense everybody is pondering over, and that is the point which you want to take forward with Matt Orton also, to understand that what he makes of this welcome back Trump rally. So Matt, welcome to the show. We are calling it the welcome back Donald Trump rally. The point is that how long will this warm welcome continue?
Hey, good morning. Always great to join you. And I think the welcome for the Trump rally really ended in December. Most of the gains you had, especially in the cyclical parts of the US market, particularly those related to small caps, those related to reshoring, financials, and deregulation, nearly all of those gains, if not all and then some of those gains, have been given back in the month of December in the first couple of trading days right now. And I think what the market is focused on going forward is what is the likelihood some of those Trump policies actually get enacted. It's unlikely that everything that was talked about or promised on the campaign trail is actually going to come to fruition. There's a lot of uncertainty in the market, particularly with social media being used as a bargaining chip, as well as what tariff policy is going to look like going forward. So I would expect that we're going to see a lot more volatility over the next couple of weeks until we get to inauguration date. Once we're there on January 20th, on January 21st, we'll see what those day one executive orders look like. And I think that will set the tone in terms of whether some of these deregulatory trades, the energy trade, if a lot of that can pick back up some momentum. So I think we're going to be range bound in the near term.
The other question is, with the dollar index at an 8-month high and pretty much sticking by with that and the continuous dollar strength, what would it mean for flows to emerging markets and especially India? Because we've seen the FIIs completely turn their back.
Yeah, I think the dollar is a headwind to the entire international complex, both international developed and emerging markets. It erodes, especially U.S. investor returns when you invest overseas. But particularly for emerging markets, it's a headwind for domestic economies and financing as well. And so I think the onus on investors looking at emerging markets, given an elevated dollar, is going to be selectivity. Do I think the dollar rally is going to continue the way it has? No. I think a lot of the worst news with respect to US rate rises, a lot of that has already been priced into the market. So I would expect we see a little bit of weakening of the dollar, but not substantial. So that's likely going to be a headwind for the broad emerging market complex. But there's definitely good opportunities beneath the surface. And a lot of that's then going to be idiosyncratic growth factors, particularly related to earnings and earnings momentum. So countries like Taiwan, as long as the AI trade can continue, you're likely going to see Taiwan semi and really the semiconductor chip trade continue to move. Countries like Vietnam benefit from friendshoring, and India also has benefits of that friendshoring, having a good relationship with Donald Trump and the US, being a supply chain alternative from China as investors and companies alike continue to pull assets. And I think if we do see an earnings reacceleration going forward, which is my expectation as we head into the back half of the first half of the year and into the second half, I think a lot of that's going to get FII money to come back. I don't think the dollar's the headwind for FII money. I think it's uncertainty with respect to the global economic outlook and just not wanting to put new capital to work until we have a little bit more clarity with respect to where performance and outperformance is going to be driven.
Matt, in your note, you've talked about, a whole host of sectors as well, which you think are going to do well. So obvious to say that it's the technology names which will continue to ride high, especially in the US, which has been the case, especially the ones with that kind of AI flavor to them?
Yeah, I think information technology and the communication services, kind of consumer discretionary names that are tied to artificial intelligence, those names are going to continue to do well. And I think software in particular is set up very nicely in the US to ride the wave of AI spending. And when I talk to clients, really what I encourage them to look at is not necessarily continuing to add more money to the hyperscalers, which I still think are very, very good investments to own going forward, but it's to look at the chain of where those CapEx dollars are being spent by those big companies and look to invest in the companies where the earnings momentum is not baked into the transparency and the visibility that you have with respect to earnings because of the CapEx. So electrical equipment companies are top on my list. I think cybersecurity companies also look very, very attractive. And then even when you come to India, for example, IT services had done well. I think that's an area that can continue to do well because they're tied to the success of US and global companies where the economies are recovering, particularly financials and asset managers. So companies like Infosys, for example, that have a large part of the revenue line tied to asset managers on a global scale, those look attractive because their earnings continue to pick up, and they also have leverage to the AI trade on a global scale. So there's definitely a lot of ways you can play that theme from a global perspective and in India as well.
Thank you so much for taking the time out and speaking with us, helping with your take on the global markets as well as your India strategy as well. Great chatting with you.
If you like this video, then like, share and subscribe to ET Now.